Hey, good day, everybody. Welcome back to our next edition of Check the Map. We are now in the month of February 2026. It's crazy that we already have 1/12 of the year done by number of months count. So I'm Tyler Bannister, joined by Nick Wages and Kirsten Crum of SRG Financial Advisors. A lot has happened in the world in the last 31 days or so. Well, we certainly don't have time to talk about everything. We're going to stay focused on the things that apply to you and your planning and your investments and where we're at so far into 2026. So currently, as of recording, we are in a what will hopefully be a short government shutdown compared to the one we had in the fall of 2025. That being said, we still have some data and reports that aren't going to come out on time this week. Hopefully, the government shutdown is resolved at some point. Uh, that doesn't delay tax time at all. Just FYI. So we still are at the start of tax season. So make sure you're working through that on your own with us or with a tax preparer of your choice. So tax season is still in full swing. Um, Also, the Social Security offices, it's if you're trying to start your Social Security benefits or make a change in person, because you can't make some changes over the phone anymore. There are going to be appointments that aren't available because of the government shutdown. So just be mindful of that. Most things you can do online if you go in and set up your login.gov or ID.me account. But so those are some things that might be affecting you as you're trying to get Medicare set up or Social Security benefits updated or change direct deposits, whatever it might be. So year to date, so far, 2026, 1 month in. So this is through January 30th of 2026. It's been an interesting few weeks, no doubt. The U.S. aggregate bond index is slightly up for the year, about 0.2%. Real estate, just as an asset class, is up about 2.5% year to date. We have large cap US stocks, so the Dow Jones up 1.7 roughly, the S&P 500 up about 1.37, Russell 1000 up about 1.3. Where we've seen some bigger gains on the equity side thus far is actually in small cap companies. So US small cap companies, Russell 2000 up over 5%, about 5.3% year to date through January. Also, on the international equity side, so we've seen um, developed international markets up about 4.9% and emerging markets up a little over 8% year to date. So this is just an example of why it's important to have strategies that can look at these different asset classes with a systematic and formulaic based approach instead of emotions and how we're feeling, right? As some of you know, when we're employing strategies for long-term growth, we're going to lean towards strategies that look at data and make data-based decisions, what regardless of what's happening in the world. And you can see right now, there's been a lot of talk about the international climate, international trade, new world orders. I mean, just so many headlines. It can be kind of daunting and confusing. U.S. stocks are doing decent, actually, but there have been opportunities outside of the U.S. this year to take advantage of. Gold and silver, respectively, gold's up about a little over 8%, silver's up a little over 17%. That's after a big drop last week. So a lot of interesting moves happening there. And on the crypto side, just of note, Bitcoin year to date was down over 5%, so negative 5.23% to start the year. Over the last 12 months, Bitcoin also negative. So you've heard talk of Bitcoin being the digital gold, perhaps. Some people throw that out there, and you can see that over the last 12 months, real gold and Bitcoin have been on opposite tracks for sure. So, very interesting start across asset classes for the year. Nick's going to cover some really pretty positive economic data here in a minute. Kirsten's going to dive into consumer confidence, and part of this might be all of the headlines and things happening in life that can affect people's emotions, because that's what consumer confidence is really asking, is your emotional outlook.
Yeah, absolutely. See if you guys can see my screen.
Yep.
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 Awesome. So like Tyler was saying, consumer confidence index is maybe showing not as positive news as we really see in what the market is doing overall and some of the true economics we've actually reports that we've actually gotten. So the Conference Board of the Consumer Confidence Index, this fell 9.7 points in January, back from what it was in December. So we'll take a look. Obviously kind of a sharp drop. You know, a lot of this was a few different indicators from folks saying it was trouble to get new jobs. You know, we're not really seeing mass firing happening, but it's maybe harder for those, especially right out of school, trying to enter the job market right now, is a possibility for why this consumer confidence index has kind of taken a drop recently. A few points that I had here as far as consumers' views on the current business conditions. Percentage of them saying that conditions are good has gone down slightly since December, and some saying that businesses are doing bad, which is also slightly up. So again, is this just the emotions talking of how this effect is affecting people? Because it's interesting when we actually look at the market and the exposure to like money managers that we have in the market right now. This is the NAAIM exposure index we've taken a look at before. This takes a look of how exposed money managers are to the stock market itself and to the equity market. And as we see, if anything, we've had a little bit more since the start of January. So yes, maybe there's some emotions going on right now that the consumers are feeling it. However, the stock market right now isn't exactly translating that. And I know Nick has a few more details as far as positive economic data that we've gotten that shows also why we're seeing the market doing pretty well.
Yeah, and it's hard not to assume that a lot of what is weighing on that confidence index would be the job market, an unemployment rate of 4.4%, but probably I would say roughly equal to one person looking for a job to every job that's open, like a 1-to-1 ratio. And that coupled with the fact that if you're getting out of school or you're early in your career and you're starting to think about what it might take for you to buy a house, be able to afford to make a down payment and buy a house, those are two pretty big headwinds when looking at confidence at the consumer level. A lot of that exposure data that you're showing, I feel like is a lot more of a testament to what Tyler mentioned with, institutional investors, money managers, strategists, really focusing on the data and having data-driven approaches to investing in different asset classes. We've seen, obviously, this year, we've talked about with the Fed lowering rates, although they held them steady last week, but with a few rate decreases over the last quarter, there's clearly more risk being taken on at the small and mid-cap company size level, as well as international investments. Whereas prior to that, really, there was a pretty heavy concentration in large cap. And really, I think we talked about this in our last broadcast too, a pretty heavy concentration into the Mag 7, like the top 7 companies as far as cap size goes, really affecting the S&P 500 and the NASDAQ pretty significantly. So seeing money start to move away or into other asset classes is really kind of encouraging. It shows there's opportunity elsewhere, even when confidence could be down. Headlines certainly don't say, hey, be optimistic about everything that's going on in the world right now, right? There's some really troubling and disappointing things going on socially, but economically, especially here at home, when you look at the wave of data that's come out here over the last month or so, I'll rattle through a lot of these and just kind of talk about the encouraging signs that they are. Orders for durable goods rose 5.3% in November. Retail sales rose 0.6% in November. Existing home sales, which we track this one really closely because of the affordability issue with buying new homes. Existing home sales increased 5.1% in December. They actually hit their fastest pace of sales since 2023 at about 4.35 million units per year. Now, granted, it was like 5.25 million per year before COVID. So we're still, kind of weaning off of the effects of the money from COVID, the lower interest rates. Hopefully people are finding a little bit more stable footing. the median price of an existing home did drop slightly to 405,400, and is only up 0.4% versus a year ago. So potentially eyeing some better affordability maybe on the horizon. Industrial production in December increased 0.4%. The trade deficit ballooned back up to 56 billion. However, one measure within this report that we like to follow and track is the overall activity of trade, not just whether or not we were more balanced in what was coming in versus what was going out. And the overall activity or level of trade increased by 5.9 billion and is up 1.5% in the past year. So obviously, in order for that to happen, people have to be spending money. Which leads me to the next report. Personal income rose 0.3% in November, and personal spending over the last year is up 5.4%. So income is up 4.3%, spending is up 5.4%. We've talked about our credit crisis here in the US, and that's kind of a little bit of a tip of the cap to why we might see the household credit levels going up when our spending is outpacing our growth
income increase.
our income increases. Yep. Two fairly conservative signs from the inflation front. We ended the year up 2.7% year over year on the consumer price index, which, although it's higher than the target, and although prices haven't come down at all in most cases, other than energy prices, it still is our best inflation reading since 2020. So at least we seem to be heading in the right direction. And then the producer price index was up 3% year over year, which again is another improvement over the previous year. Real GDP, so gross domestic product here at home, was actually revised up to 4.4% in the third quarter of last year. So this is the wave of data that we've seen and we've reviewed the reports for over the course of the last 30 days, really actually probably about the last 2 weeks. There's a lot of reasons for optimism, and you can clearly see consumers have not stopped spending money. So consumers spend money, companies make profits, earnings are high, and there's opportunities for investments. And I feel like that's kind of what's driving, really a pretty strong start to the year that we've seen out of, most markets.
Yeah, I was going to say another thing to mention is earnings the past 2 weeks. A lot of those Mag 7 companies had their earnings, and most all of them, at least that I've seen, have all beat earnings, had good outlooks for the rest of the year.
Yep.
Everything's all the AI race and what they think it'll be by the end of the year. But needless to say, the facts versus just purely consumer emotions are showing that those are beating earnings lately.
Yeah, and we've also this is another encouraging sign too. So the manufacturing index has been in contraction territory, so a reading below 50 for basically the last 3 years. For some reason, way better than the consensus expectations of a 48.5 reading for January. That report came out today at 52.6. So manufacturing is actually pretty healthily into expansion territory here in the US. And the services index, we've talked about that often as kind of being what was pulling a lot of the weight of the economy during those higher inflation years coming out of COVID. So super encouraging to see the manufacturing picking up as well.
Yeah, absolutely. Kirsten, assuming the government reopens in a timely manner, what does our data calendar look like for the next couple of weeks?
Let's take a look. Yeah, of course, dependent on when these numbers actually get to us. Can you guys see this?
Yep.
Yes.
All right. So today's February the 2nd. I can't believe it's already February, needless to say. So today we have that manufacturing and PMI coming. Again, this is all dependent on when we get some of those numbers coming our way from the government shutdown. JOLTS job openings coming up this week. That ADP employment, that is the private employment numbers we should be able to receive even under a shutdown. Thursday we would get those initial jobless claims as well as the non-farm payrolls, unemployment rate, and all of our job data on this Friday.
And they're
Moving
already saying
on,
that Friday will be delayed. All right, they're
yeah,
already
I did
acknowledging
see that.
Friday's report's delayed for employment, so we'll have to wait
Yeah,
another
of
week probably.
course. Well, then we can't have a revised one a couple months down the line now. Uh, Next week, retail sales, going to see what that consumer is truly spending, inflation rate. I'm sure they'll find a way to see if they can push that one off as well. Existing home sales coming to us next Thursday, and then we should be meeting by this next coming week. We have FOMC minutes.
Yep.
Of course, that's one to dig underneath the headline to see what's truly said versus what the headline might want us to think they're saying about the CPI and the inflation report. And then some more home sale reports coming that following week. So it's the next few weeks, of course, depending on when we get these numbers.
Awesome. Thanks for that. I will I want to share one thing here just as we close out, just because let me know if you guys see this as far as
Yep.
the reserve currency chart. So this is from the
Mhm.
Atlantic Council and the sources for from the International Monetary Fund. And so we've got, just looking back at the last 10 years, essentially, as far as the percentage of the world's reserve currencies, the dollar being the bulk of it. So I want to close with this because over the last year and even so far in 2026, we hear a lot about the dollar and as the reserve currency and gold and all these things. So BRICS is a real thing, right? Other countries would certainly like to try and have be the reserve currency. So I'm not dismissing that. But just again, to look at the data, if we look at the last 13 months, the talk of the decline of the US dollar, the decline of the US dollar has just been pretty consistent from a lot of different places. When I put the cursor on the chart, so this is the percentage of the world reserve currencies that the US had. So in 2024, we were at 57.79%. 2025, 57.74%. So we had a a 0.05% downward move from 2024 to 2025. So yes, it did go down, but I think unemotionally it didn't drop off a cliff. So again, just coming back to making sure that we're approaching financial planning with an actual plan, with a comprehensive plan, looking at the overall picture and making decisions on how these different parts of your planning interact, from Social Security and taxes, investment allocations, distribution plans. How do those all interact with each other from an allocation standpoint? Can we approach things as unemotionally as possible based on data, looking at opportunities across the board and not chasing headlines, not emotionally reacting? The key to long-term investing success is having time and not reacting emotionally, right? So just wanted to throw that out there because you're going to continue to hear a ton of headlines. Again, there you can see there is a gradual downward trend on the US dollar. That's a real thing. But it hasn't just fallen off a cliff all of a sudden. And then even as we're recording right now, today, the U.S. government and President Trump, they announced that they reached a trade deal with India, which is a huge player in the BRICS group of countries, and that we're going to be lowering tariffs apparently and having more free trade with India. So again, narratives are going to be narratives, emotions are emotions, but having a prudent planning process in place, like the mile marker formula, is essential to long-term successful outcome. So as you guys are working through your tax planning, tax preparation, if you have questions, if you have friends that have questions, feel free to reach out. We're here to assist households with their planning. 573-302-7212 or srgfinancialadvisors.com. Thanks for your time, and we'll talk to you soon.